Thanks, Tim, and thanks for having me. So I'll give you a 10-minute overview on the company, and then we're happy to do some Q&A. I'll also touch base quickly on the first quarter of trading and the big questions in the room. How are we impacted by the recent environment of the COVID pandemic? So my name is Fabian. I started Marley Spoon 6 years ago, and what we're doing at Marley Spoon is we're bringing delightful, market fresh, and easy cooking back to the people. We want to make it easy for people to cook, because when you think about it, you walk in a supermarket, you're seeing all the fresh ingredients there. There's like meat, fish, vegetables, everything is there. You could cook anything you like, but when you leave the supermarket, for me, I always feel like I end up cooking the same 2 or 3 things, like steak and broccoli, steak and green beans. So we felt like, why can't we make it easier to cook? Like, I don't know, a salt and bocca with sugar snap pea, a polenta mash, or a chicken supreme on a lentil bed, and this is what our customers can cook every night. Now, we make it very easy for those customers to cook without actually any effort. And the way it works is we have these chefs that create recipes. There's 30 recipes every week for you to choose from. And then you just tell us, what is it you like, how many portions you need, how many times per week you want to cook with us. And then we send a box to your home once a week. And in that box, you have all the fresh ingredients, the recipe cards, everything you need for weeknight cooking. Now, the only thing you need is salt, pepper, and oil. Everything else we ship to you. And people love it for multiple reasons. Of course, it's great to cook from scratch. It's much healthier compared to cooking processed food or frozen pizza. It's also nice, of course, to cook and then sit together. When you cook, nobody sits in front of the telly. Everybody actually sits together, and making that easy for our customers is what they appreciate. Now, what they love most about the service is that we make people's lives easier. There's so many things for you to worry about, to think about. What are we going to cook tonight is not a problem for you to think about anymore. Now, that's something that we really make easy for our customers, and that's what they love about Marley Spoon. Now, we do compete with supermarkets because that's where you used to get their things. And there is a big problem with supermarkets most people are not aware of. That is, a supermarket, like any retail business, they source to stock and then they sell from stock. And the problem, if you do that with perishable items, is they perish. You got to throw them away. In fact, up to 30% of these ultra fresh items in supermarket shelves, they have to be thrown out. Because if you don't pick them up in time, they're going to be thrown away. And this waste is terrible, because when you think about 30% of waste, is not only terrible for the environment, because all of the fresh water, 70% on planet Earth actually, is not going into washing our cars or showering. It's going into agriculture, methane emissions, CO2 emissions, all of these resources we use. We invest into growing things on field, and then half of what we grow on fields ends up being thrown out. But it's also a cost problem. Somebody's paying for that waste, and that's you, the customer. Supermarkets have to mark up the prices to cover for that waste. Now, Marley Spoon, we're not a retail business. We are a manufacturing business. So think about us more like a Procter & Gamble, a Unilever. We manufacture a consumer branded product, but unlike these CPG companies, we're not shipping this to the retail sector. We're going direct to consumer. And this direct to consumer has a profound impact on our supply chain, because it allows us to only buy the food where we know that we've sold it already. So therefore, our food waste is not 30%. Our food waste is actually less than 1%. We don't have any. And that powers very strong margins in our business model. In fact, it allows us to price our product at the same price point as if you would buy all the ingredients we ship to you at Woolies and Coles. So in the end, you would pay the same, but our margins are extremely high. In fact, in our first quarter, our contribution margin was around roughly 30%. And that is because we don't have any of the waste that you would normally associate with the supermarket business. So our business is really about acquiring customers, building recipes around the data that we achieve from our customers as they use our products, that allows us to source from the right wholesalers and manufacturers directly in our manufacturing facilities, and we use third-party logistics to ship it then out to our customers. So when you think about the overall positioning of our product, it's really about these 7 weeknights where people are looking for a solution to cook. We tend to serve those weeknights that people cook at home. On average, our customers, they cook 5 times per week, and out of these 5 times per week, we are able to serve them on average 3.5 times. So it's a high frequency product that our customers use. And when you think about takeaway, which often is I'm being asked, how does takeaway compare to cooking at home? We actually see that people do order also pizza that cook with Marley Spoon, but you wouldn't actually order pizza for your family every night. Now, that's something that you do maybe once a week. In fact, we see on the weekend on Sundays, that's normally when people order in. So what we really see ourselves primarily competing with Woolies and Coles, as we see customers that cook with Marley Spoon, they actually tend to shift a significant amount of spending monthly from the supermarket to us. In fact, on average, an Australian customer, they are actually spending 240 Australian dollars every month with Marley Spoon once they ship and switch from the supermarket to us. So we really see here a switch in behavior as people discover meal kits as a better, more convenient, more variety way to cook. And it doesn't even cost them more. They realize that this is a long-term better solution compared to supermarkets. Now, talking about the first quarter, the company had a record quarter, and that was a record quarter before actually the global pandemic hit us. The first quarter saw strong growth, up 46% year over year, which was an acceleration to last year's growth. So we saw a really strong growth of the business. And then at the end of the quarter, we saw the COVID environment impacting, seeing an acceleration of our business. But even before we go into what happened afterwards, we actually saw also in Q1 already the first time in the 6-year history that we were seeing positive operating cash flow. And in general, the cash flow in our business is always ahead of profit, meaning our customers pay us 6 days prior to getting their box, but we pay suppliers 45 days later. So we have this negative working capital cash cycle that allows our business to generate cash as it grows. So we achieved this important milestone in the first quarter. And this was driven on the one hand side by the increase in revenue growth, but also, as I mentioned earlier, the record contribution margin, where we were hitting 29.5% contribution margin, which is up 5 points year over year, which is above the record that we set in the fourth quarter. Now, the company always had guided that it would be profitable globally by the end of 2020. Due to the current tailwinds, this was brought forward. In fact, the company is profitable as we speak right now, so we will be profitable in the second quarter. And that growth and that profit is driven by growth across all the regions. You see US, Europe, Australia, all contributing to that strong growth in the first quarter. And important, sometimes people ask, what's the balance between growing by new customer and existing customer? Our business is really driven primarily by repeat order purchases. In fact, 92% of our sales last year were returning customers. Or if you look at the ordinal, 64% of the 3 million orders of last year, they were actually order number 6 or higher. So our business is driven by this back book of user behavior, which was quite important also by the behavior we saw now due to the current pandemic crisis. So it's a business that's driven primarily by the back book of loyal customers. And that is across 3 regions. We operate in Australia, US, and Europe. Think about Australia and US being the big major parts of our business. In fact, Australia is our most mature part of our business. We've been operating profitably in Australia for the last 12 months. The business in the first quarter grew 56% year over year, and margin another 6 points to very strong 38%. This really shows you and leads you the way why this business is so attractive, because it generates very, very high margins, as our supply chain, as I mentioned earlier, is completely waste-free when it comes to the customer. So it's a very effective way to serve customers, generating high margins. US also growing strongly, margin-wise, probably 12 months behind, but eventually expect similar margins in the US compared to Australia. And Europe growing a bit slower, but also driven by slightly slower margins, which is driven by the supermarkets having more competition in Europe, and therefore price points tend to be lower, which then also makes the Marley Spoon product a bit cheaper. That in turn, of course, reduces lifetime values, and in order to get similar return on capital invested, we are much more careful to invest into growth to ensure similar unit economic profitability across all 3 regions. So that's kind of the profile and the footprint that you have, and you can expect to see the business growing now strongly across all those 3 regions, because what happened at the end of the first quarter, it was on the weekend of March 13, actually, when I came back from the roadshow flying from Melbourne to New York. Actually, on that Friday, we saw a surge in demand in Europe. On Saturday, Sunday, it happened in the US. On a Monday, the surge in demand started in Australia. So we really saw globally over this one weekend 2 things happening. On the one hand side, this back book of business, this base behavior, we saw our customers, they wanted to have not the box only more often, so they skipped less often as there's no business trip that stopped them getting their box. So we had higher order frequency, but also instead of 3.5 times cooking, we saw customers maybe cooking 4.5 times. So we really saw a surge in demand by our existing base that lifted the business. And then we saw a wave of new customers coming in that also looked for safer ways and better ways to serve the families, to cook for their families. And that was quite dramatic, to the point that we, quite unusually, normally we don't do this, but when we spoke about the first quarter, we also released trading data around April. And so in these calendar weeks 13 to 17 in April, we saw a business grow more than 100% year over year in April. So you really saw a strong acceleration and growth, and you could see that across all the regions. So for me, what happened is, in general, when it comes to online grocery, it's actually still a very early stage. Consumers haven't really switched from offline to online yet in groceries. So what you see in toys and electronics and books, where 30, 40, 50% of these verticals switched to online, this had just started for groceries at the beginning of the year. Roughly 3% of grocery sales had switched from offline to online. And it kind of feels over the last 8 weeks, and we see more and more data now, that this has gapped up. So for us, it feels like there has been an acceleration of an adoption that would have happened anyway, but it now happened much faster. And some statistics assume that maybe we saw 100% growth year over year in adoption, meaning you go from 3% maybe to 6% adoption rate, which still means this is early. Of course, it's a dramatic acceleration, which we see in our business also, but it's still very early, meaning for us, we still feel, while the business is now on a run rate basis of roughly, take the 22 million euros in sales in April, you're roughly at $500 million Australian dollars in revenue run rate. This is still for us day one in an industry that's just starting to get adopted by consumers. So as a summary, to make sure we also stay somewhat in time, the business in Q1 was trading strong. And then we saw the current COVID situation appear that generated tremendous tailwinds for the business. The business is growing dramatically. It's growing dramatically while margins have been very, very strong in the first quarter. So it also, the company was ready operationally to also supply and this demand that was suddenly there. And we saw margin improvement across all 3 regions in Q1. And we do expect that margins will continue to improve. The business is profitable now as we speak. And again, as I mentioned, it's really day one in this development. So we feel like there's lots of more to come over the coming years in terms of adoption. Tim, any questions I can answer?
Yes, there's a few questions. Thank you, Fabian. A quick one. Are you listed in the US as well?
No, we are just listed in Australia.
Right. How did that come about? Why Australia?
So when we listed 2 years ago, we were still a bit too small, to be honest, to list in Frankfurt or in the US. Now, we did a 70 million Aussie dollars IPO, which is a bit too small for Frankfurt and US. And also our Australian business always has been the most mature. Lots of our shareholders that subscribe for the IPO were also customers. And it's also much easier to explain what you do if your customers love your product and understand how your product works. So Australia was a great environment for us to list the business. That's why we decided to list the business in 17 in the summer.
Understood. And where is the competition position? HelloFresh and is Blue Apron, they're your big competitors globally?
Yeah, it's interesting. So what we see is, we see that it's actually a quite benign competitive environment. It's actually just a duopoly. There's HelloFresh and there's us. We're the only 2 global companies. Now, HelloFresh is 5 years older. We are the younger company. We're normally a little bit more innovative. We introduced choice. They didn't have any choice when we started. With 30 options every week, we have more choice than everybody else. We also introduced Dinnerly, which you might have seen on TV recently. It's a budget brand. It's very successful in the US and also in Australia. So in a way, it feels like there's a duopoly globally. And then in the US, you have 1 or 2 other players. But given that the space is so big, we don't see really any constraints of growth due to competitors in the market.
There's just another question here, maybe a little bit, let me see. Can you elaborate a little bit more on your supply chain?
Yeah, so the way our supply chain works is we have 30 recipes every week, but these 30 recipes just have 200 SKUs. So it looks a little bit like a Lego system where our culinary teams plug together certain SKUs, which by the way is much easier than supermarkets who have to have 25,000 SKUs on average there. So it's a very reduced system of specific SKUs that we then directly source from producers or from wholesalers. So we don't go to retail. We really skip retail and we skip wholesaler. And that allows us to be very, very attractive also in our ability to get good prices and also circumvent supply chain challenges that we've seen recently quite a lot, to be honest. You saw restaurants shutting down, you saw supermarket shelves being empty. So there was lots of variability in the supply chain. And we were able to navigate quite nicely because in the end, the customer doesn't expect a specific SKU, they expect a recipe. And if we have to change this last minute to protect our margin or to ensure we can deliver, then that's fine for the customer. So there's quite some flexibility in our supply chain built in by the way our service works.